Hi, you're listening to Avenue Insights. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Any views expressed in this podcast are based on information available at the time and are subject to change without notice.
Welcome everyone back to another year of podcast from Avenue Investment Management. We thought for this quarter's podcast, we would once again go over the quarterly letter from the end of the year, touching on some of the core themes from 2023, and then talking about what we're seeing into the new year, 2024. I think one of the things we did to start off this letter was to touch on Charlie Munger, who, of course, former vice chair of Berkshire Hathaway. And the quote that we used to lead off was really his reiteration of the importance of time when it comes to investing, and that it's important to not interrupt your compounding unnecessarily. And so I think one of the things, just to touch off on the beginning, is just saying, as we highlighted in the letter, the end of 2023 was the 20th anniversary of Avenue. So Bill, maybe spend a few minutes talking about sort of the importance of that, really the genesis of why Avenue was started, all that 20 years ago, and then sort of maybe talk about sort of the vision that we have continuing for another, 20 years and on from there.
Yeah, in the quarterly letter, it's really, 20 years of doing this and thanking everybody. And Avenue wouldn't be here today without the support and trust, and going back to year one of saying, okay, we've got this really great idea, and there's still that element of trust of here's our money, we're going to go and we're going to execute this investment strategy. And we would argue right from the beginning, it's still the same strategy today. And with that idea of just, can you be a long-term investor? What gives you the highest probability of having success as a long-term investor? And that's where that Charlie Munger quote comes from, which is just, you're trying to avoid the big mistakes. And so there's always some part of the stock market that's just shooting up in one direction, but there's other things that are just tanking in another direction. And so how do you come up the middle to get the rate of return, the best chance of getting the solid rate of return over time? And this is what we talked about now just, for years, which is a high quality business, consistent underlying cash flows. And then on top of that, if we all the time analyzing these businesses, can we just make sure we buy them at a good price? And then the point is, you then have to hold them. And last year, going through 2023, it was another one of those great years where short-term interest rates shot up. And then just, oh my goodness, are we going into a massive recession? Could we have financial collapses? And the extraordinary thing is we actually had two of the largest bank collapses in U.S. history. And somehow the economy just sort of floats through it, and the stock market floats through it for all sorts of different reasons that are hard to predict. And so if you just have your businesses, hold on to your businesses, and we come out the other side and we've made money. And so I think it's a great way to sort of, again, acknowledge what the idea was, and we've done it through 20 years, and we're quite happy. All sorts of things have happened over time, and there's years can go by where the strategy where you're not making as much money as we'd like to make, but we're still investing in those companies. Those companies are all making money.
The other thing too, maybe touch on this angle from all the way back in 2003, but really, part of the idea at the beginning was, yourself and other partners, founding partners, having spent, a previous decade plus in the investment industry, but not actually being able to manage money the way you wanted to manage your own money. And this alignment of interests that didn't really exist in the investment industry 20, 25 years ago. And so the importance of actually building a portfolio and an investment strategy that, we as principals and portfolio managers and owners all want to own what we're doing, rather than, an investment industry that obviously frequently exists to do one thing for clients and do something else with your own portfolio.
Yeah, and it's actually the subtle point. Again, years go by and you sort of forget talking about exactly those points. And it's not so come here to do this every day, but also more importantly is that the anomaly when we were all at TD Asset Management is that we were managing the client's money one way, and I was having quite a successful time managing my money completely differently. Mm-hmm. And so the idea was to stop doing that, manage our money the way we think it should be managed going forward. And then if people like the strategy, come and join us, and we're going to make sure we have the most consistent run we can. And when the story I always give when it comes to Christmas dinner, and this is this is the rate of return I got. My sister got the exact same rate of return. This is 100% of what I own, and it's commitment to this strategy. And you do know there's going to be all sorts of wild, hot stocks, and you just have to sit and be patient and say, because we can't figure it out, we're going to try to figure out the things we can figure out, which is this a high quality business? Does it consistently make money? And then if we can extrapolate in the future, this is how we can get a consistent rate of return if we're super patient.
And so the other thing too, we touched on the letter was this idea of, just going to the most simple level and posing the question, why invest in the first place? I think sometimes that gets lost. There's not really as much clear communication on that, or expectations of, why are we even doing this? Why are clients even doing this? Why do people need to invest their savings? And I think the one thing we try to reiterate, and looking at over the arc of Avenue's 20 years, just how much of an impact inflation has on prices of your consumption. So the idea being, you can choose to consume all your money today and your savings today, or you can say, I want to consume that in the future, but I know that the prices of the goods I want to have are going to be higher in the future. So how do I protect my purchasing power, which is essentially, what investing is all about. But maybe touch on that and the importance of maintaining your purchasing power. That's really what we're trying to do for people. And then in the context of course, inflation has been more of a hot topic in the last couple of years, and it doesn't seem like that is going away anytime soon in terms of rising prices. And that would be our expectation, that this is going to be, a challenge going forward that we have to meet in terms of, growing our purchasing power over the next 20 years. Yeah,
and I'd start with the idea that even 30 years ago, a lot of Canadians would have most of their wealth in their house, and they'd have a pension plan. And so the house, your principal residence, and it's tax-free in Canada, that's extremely important part. But the pension plan has sort of gone away over the course of my career. And so really what we're talking about is protecting our savings, our pension, and creating our own pension strategy and protecting that from inflation. And we've had this extraordinary run where interest rates went low and housing prices have gone up. And even if there's not a risk that the housing prices are going to pull back, they might just stay high. That doesn't mean you're going to make money on your house, but just it's an expensive house and it stays expensive, but we still have to retire on a savings portfolio. And where we've gone through a period of low inflation, and this is a couple of the slides from the quarterly letter that hopefully we're going to put on this. It just shows that we're now in a period of accelerating inflation again. And so it really is an issue with savings. If you have, money in a bank account, the value of it erodes really quickly. And if you have money in a company, and the company can reset prices and maintain their profit margins and still grow incrementally, is the best way we can think of that you can actually maintain your purchasing power over time.
Yeah, I think it's one of these things where on a year-to-year basis, sometimes price changes aren't that noticeable. I think from pre-pandemic 2020 to now, of course, we can you can pick anything out of a hat in terms of we're seeing higher prices today, but generally in a year-to-year basis, you're not noticing it. But if you look at over 10 years, 20 years, 30 years, whether it's housing, whether it's things like gas, whether it's groceries, whether it's rent, all of these things are embedded in our day-to-day spending. And if you look back on longer arcs of time, you realize how much prices go up over time. And so I think the idea is always to say, taking our money or taking our savings today into the future, the only way you're able to do that and maintaining your purchasing power is through owning high quality equities. The one thing we've tried to reiterate in some of our communications and the language in the last couple of years is really defining how we classify a high quality business. And you touched on it a little bit. Companies that are able to reinvest in themselves, have some level of pricing power. Oftentimes we found in the last couple of years, companies that don't need outside financing are also in that category where you can be funding your growth and your reinvestment in your business without actually having to tap, the markets by selling debt or borrowing money from a bank. And so all of those things become, I think, a much tighter focus in a higher inflation and higher interest rate environment. And I think the nice thing about the current setup is that we found a lot of great companies that are actually doing that and achieving that for us. And I think, our expectation is that focus on high quality companies is going to continue to be a great way to invest, over the next many years, whether or not we have inflation ramp up again or not. But, is there anything you want to touch on sort of that aspect of quality and how you think of it and how
this has happened over the last couple of years, because as we went from a low inflationary environment to this higher inflationary environment, if we talk about how many changes we made in the portfolio, and so there was a period of time when we were going from 0 to 1% interest rates to 5% interest rates, just like, wow, this is really going to change things. So we brought this up a few times on these podcasts of saying how much the portfolio has changed in the last year and a half. But now we really feel like the type of businesses we own now, and for this environment that's going to be a slightly higher inflationary environment, and we think we've really rebuilt the portfolio and it's in great shape. And hopefully we can really stick with these businesses and let them run. But the previous 20-year businesses that we'd bring in the investment meeting and say, okay, does this make sense? Does this make sense? But it makes sense in a low inflationary world. And even though we're talking about what was sub 2% inflation, and now we're really just talking about it might be 2 to 3% inflation, that's a huge difference in terms of when we're looking at businesses and the type of businesses that can maintain their profit margin and still grow and then not get hurt by the cost pressure, labor pressure, and all that type of thing that's more likely to happen at these big trends that we're going to see going forward.
Yeah, and I think the other thing too is at the turn of the year, we're almost a month into the new year, and the markets have sort of kept squeezing higher, you could say, from the beginning of the year. And I think the other thing we touched on in the letter was just highlighting, our rough estimation is at some point there's going to be likely interest rate cuts this year, with the idea that that's the main reason why the market is as jubilant now as it is.
But it's also just not to interject, but there's just an awful lot of money in the financial system.
Yeah, and it doesn't seem to be going away.
Budget deficits, and you've raised just one interest rate, one short-term interest rate, but there's just an awful lot of money in this, and the money is concentrating into just one very focused part of the market.
As we kind of move through the year, I think the question will be, if the economy stays resilient enough where there's not need for interest rate cuts, then I think a lot of this kind of jubilation in the market probably will get challenged at some point this year.
So I want to tee that up for you, because this is the part of the argument in the quarterly letter that I really liked, is that it's saying interest rates went up. Hey, why aren't we in recession yet? And there's actually what you've done great way to sort of articulate this is there's actually a big, long lead time to this. And we're weirdly in this little mid-market hiatus now where everybody says, oh, everything's kind of all right, and the stock market moves to new highs, as we've just seen. But we're still, even though we're invested, we really like where the investors, we still have a cautionary lens. And I'll throw it back to you because. Yeah,
well, because generally, or always, when you actually get into the core of your cutting cycle, it's not good for stocks, because the central bank is cutting interest rates because the economy is deteriorating, which is means earnings are deteriorating, which is what generally is dragging equities down. So, but as you highlighted, there's this pre-interest rate cutting period where everything still is okay, but the threat of higher interest rates has been taken off the table. And that's kind of, I would say, where we are right now. But once you get into an actual longer cutting cycle, although it seems like interest rate cuts should be better for stocks, but the market, that's what the market's pricing in right now. When we get to the cuts, generally, if you look back at the last many cycles, it's actually the worst time for equities. So that's what has us cautious, not knowing or having a particular opinion from any of us, like when that's exactly going to happen, just knowing that it is on the horizon. At some point, it'll be here. But at the same time, with the sort of the long duration at which we like to own our companies, I think we're comfortable with what we own here, and we're still trying not to jump the gun and get ahead of the next cycle, but still trying to think through the next many years as inflation, potentially is going to be in a higher level, and what companies can do well and what companies are going to be challenged and stay challenged, and just sort of picking our lane and staying with those kind of investments, I think, isn't dependent on whether they cut rates at the next meeting or in March or June. It doesn't matter. But these things are all sort of out there in the ether. And so it's always, interesting to talk about them. Is there anything else on the outlook or anything you've seen recently? Maybe do you want to touch on the commodities for 2024, some of the things you're seeing, and maybe what that's suggesting in terms of the economy for the year, and then we can wrap up here, and then we'll do a separate case study.
Yeah, so it's very interesting that the jargony term liquidity, but the money in the financial system is all pushing. If there's a handful of companies, and specifically in the technology sector that have really been pushed, A lot of money is coming out of the commodity space. Also, there is a reflection of China's slower, the economy is actually net slower, and it's really a big divergence in the economy right now. So if there's no immediate in front of you reason to be positive, probably that there's a net seller, and simple things just so in the commodity space it has been weaker. We still hope to say, which we've cut back on some of those names, but we still have high quality businesses. Doesn't look like they're going to go anywhere soon. We have the ability to add to them if it does get inexpensive. Also, that whole part of the stock market itself, those businesses are inexpensive. And what's very different than a few years ago is they're all returning money to shareholders. They're all doing dividends and stock buybacks, and they're all inexpensive. So where there's one part of the portfolio where we just have to be patient, there's another part of the portfolio even today where we've had a good start to the year, and there's a number of our companies that are stocks that are all making new highs.
Yeah. No, so I think it's a mix. It's a real mix, blend of sort of overall portfolio structure that we try to achieve with that core strategy, and it's sort of that's how we've conceived of just coming up with this kind of all-weather strategy where you do have all these different components that are contributing in one way or the other, and having that diversification, I think, helps, in terms of how the portfolio is structured. So why don't we wrap it up here for the first podcast of the year, and we'll take a short break and then come back for a case study in about 2 minutes. So for this quarter's case study, we thought one of the great exercises we went through was a question that we've gotten now a lot over the last year, in asking about T-bills or GIC rates being really attractive. And I think, and as attractive as they are relative to what they've been over the last 10 years, I think we wanted to, as an exercise, sort of take that short-term interest rate and look at it from a different perspective and highlight, yes, the opportunity with short-term interest rates being higher, but then also some of the risks with interest rates being higher at the short term. How would you frame it from the questions that you get frequently? I think we all get about short-term interest rates being higher and the attractiveness, while balancing that with what the perceived risks are of that at the same time. So,
and I'll just frame it again. Overall, we've been calling these things, case studies. We've written the quarterly letter, for 20 years, and really is an up-to-date, what's going on in the market, what are we doing about it. But this is a chance for us to write about investment theory and just ideas that don't necessarily directly affect the portfolio. And so you've already brought that up in terms of saying, well, what does Avenue not do? And we're going to do a series on this. And so this is the feedback has been, well, why shouldn't I just put all my money in treasury bills because we're about to have a horrible recession? So this is great. Talking about it in January of 2024 is what can happen in the market is you don't get a recession. That's one thing, that what you think. And if everybody thinks the thing is going to happen, always what we know is it doesn't necessarily happen. But this was a great exercise of saying, just even if you had a 5% treasury bill that we had through last year, and it's a great exercise of saying, okay, don't just think, okay, I'm uncertain about the world, so I'm just going to park my money in the 5%. And anytime short term, you need the money, sooner rather than later. Yes, treasury bills and having money in the bank is always important. This is much more. This is my long-term money, and thinking about it in terms of, here's a treasury bill, and don't think about it at the beginning of the investment. If you're buying a 1-year treasury bill, let's look at the world 1 year from now. So we've accomplished getting 5%, but what does the world look like? So then we go back and analyze that you have interest rates where are high at the short run and long-term interest rates are lower is a real aberration. If you think about it just intuitively, you can't take on more risk of lending to somebody longer term and not charge more money for it. So it does happen periodically through history, but just understanding that it's a sort of an anomaly of where interest rates, this long interest rate cycle are, and that it will probably reverse itself. And so if we think that long-term interest rates have to be higher than short-term interest rates at some point in the future, it just means one is that short-term interest rates are coming down or long-term interest rates are going up. It will probably be a mix of the both. And so when we look at how the Canadian economy has slowed down and we have a T-bill investment, The real risk of that T-bill investment is where we're going to reinvest the money a year from now, and it's much more likely that it's going to be around 3 to 4%, and then you're stuck at that 3 or 4% going forward, and you've given up the opportunity of everything else you've seen. And so I'll throw it back to you. So from our best example, and just keeping this as a tight example of saying, okay, we've got all those same parameters, and we look at even the interest rates in the bond market and what we actually did.
Yeah, I think we thought through that a lot last year. Of there's in many ways for a cash balance, having a 5% interest rate is very attractive, but it presents this reinvestment risk, which you've just highlighted, of saying, okay, you get your 5% for 1 year or for 6 months annualized, but then what happens if interest rates are 3 or 4 or 2% in a year from now, which we don't know what's going to happen, but your money is then being reinvested at a much lower rate. And hence, that's why I think we'd characterize it as a reinvestment risk. At the same time, because short-term interest rates are higher today, we've actually found very attractive interest rates in the corporate bond market, looking out 2.5, 3 years, where we're getting rates close to 6.5%. But for each of the 3 years. So that's an annualized rate of return. So it removes the immediate reinvestment risk that could come in a year after if interest rates get cut. While at the same time, we're using that as a buffer for future opportunities should there be better opportunities to reinvest in equities. But by adding those extra couple of years on the duration of the bond, it gives us that added rate of return, but we're not facing that same reinvestment risk, which is, I think, the principal thing that people have to think about for buying T-bills or GICs with their long-term money. As you said, having short-term cash balance or needing cash management in a business or for retirement, it's great to have a return on your cash if you're going to be spending it. But if you're money that you're investing for 5, 10 years or longer, there's a material reinvestment risk from short-term interest rates being here if that's where all of your money is being allocated.
Yeah, no, I think I'll just end on this, but it's in the investment industry, doing the math, it looks like, well, if we're talking about 3%, 4%, how much does it really make a difference? But in this example, if the reinvestment rate is 3% a year from now, and we've actually locked in 6%, how you win in financial markets is getting financial literacy correct. That is 100% higher rate of return. We're not even working this hard to get a 10% or 15% higher rate of return. It's 100% higher. Yeah. And just being able to do the simple math like that and get the simple math right, and then that's how we're going to be able to compound our money. Yeah, no, and that's a great note to end it on. So why don't we leave it there for this case study for this quarter, and then we'll look forward to the next podcast in the next month or so.
I hope you enjoyed today's conversation. You can find us on avenueinvestment.com, where you can learn more about the topics discussed today at our blog or subscribe for updates to our content. You can also follow us on YouTube, Apple, Spotify, or wherever you get your podcasts. Thanks for listening, and we'll see you in the next episode.